Hello, welcome to my channel. This is Wise Capital FX, and here what we do is talk about trading all day long. Please follow me on Facebook, Twitter, and YouTube. Don't forget to subscribe to the channel, and don't forget to give us a like also, and you can share this to your friends. So today we are going to talk about balance in the forex market, or balance and imbalance in the forex market, and we are going to have a detailed analysis of this particular topic and how it is of great importance to your trading. So let's get started. Now, when everything you see in the chart is as a result of demand and supply. So we are going to have a look at some economics a little bit, then we to drive the point home. So uh, demand and supply is the key of any particular market. So if we have more buyers than sellers, price will tend to go up. So if we have more buyers than sellers, price will tend to go up. Picture any product that has high demand and the supply is in limited quantity. So these will tend to push price upwards as people scramble to buy more of this good stuff. Now, if we have more sellers than buyers, price will tend to drop. However, if we have high supply of a particular product, and let's assume there's uh, no people are not interested with it, um, price will tend to drop. So in any situation, if we have more sellers than buyers, price will tend to drop. And if we have more buyers than sellers, price will tend to go up. However, if we have buyers and sellers being equal, price will not move upward. It will tend to consolidate. So if buyers are equal to sellers, price will not increase upward or it will not decrease downward. It will tend to move sideways. Today's topic was requested by one of you, and he asked me, can I prepare something about imbalance? And I thought I should come up with this content. So if you have any topic that you'd like me to address, don't hesitate to leave it in the comment section so that I will prepare something good. And if you find this content useful, as always, don't forget to subscribe. So in any type of market, we have two types of player, especially in the forex market. We have the short-term traders and also we have the long-term traders. So the short-term traders are traders like you and me, people who don't have enough cash to move the market. While the long-term traders, these are huge players who tend to provide trading volume, and they are the ones who control this market. So these type of people, they tend to use higher time frame for analysis, and while short-term traders tend to stick to a lower time frame. So it makes more sense to spend some time and learn how the big players who control the price behave like. So we've said when the market is going upward, it's very important you classify, before you trade, it's very, very important you classify the market information, or it's good you look at the chart from a point of two players, which are uh, long-term traders and short-term traders. Now, when you want to place an order, you are a short-term trader, while you cannot be big a big player. So there are trails that the big players leave in a chart that helps you to follow what they are doing. So it makes more sense for you to learn how the big players will behave, and so that you are able to follow their trail. Remember, we follow for their clues. If they're not giving you any clue, chances are very high there isn't any trading opportunity. So we've said the market can only go up, meaning the big guys are pushing the price up, and the big guys can either be bulls or bears. So when the long-term traders are in control, uh, if they are bears in control or if they are sellers in control, they'll tend to push price down. And if bulls are in control, they tend to push price up. So if you're a retail trader and you're looking at the long-term players and you see they're pushing the market upwards, there is a specific characteristics of when the buyers are in control or when the sellers are in control. So when buyers are in control, price will tend to be making higher highs and higher low. Price will tend to be pushing higher high, higher low, higher high, higher low, higher high, higher low, all the way. Now you can see there a link should be popping up on the screen so that you can see me utilize this concept in trading. Now when the sellers are in control, price will tend to be pushing price lower low, lower high, lower low, lower high, lower low, lower high, lower low. Now when both bulls and bears are equal in strength, price will tend to be moving sideways. Price will consolidate. It will be doing a sideways move, or this is what we call a range market. So price can only do one of the three things at any particular time. So that is how the long term and the short traders behave. So you as a short term trader or a retail trader or any individual seeking to capitalize on or to make some profit from the market, you should at least understand how the long term traders behave. Now then we have this special breed of people whom we call the pigs. These ones here. Now these ones are people who always don't have a trading plan. You should customize your trading plan to take into advantage how the bulls will behave as well as how the bears will behave. However, if you come into the market and you don't have a plan to utilize all these, you're just eating anything that looks like a potential meal, chances are very high you're a pig and you'll get slaughtered. There is a saying in this business that bulls make money, bears make money, while pigs get slaughtered. So avoid trading like a pig or avoid uh, placing orders anyhowly. Spend some time and understand how this concept works. Now, so but the concept of balance and imbalance. Now, a balance is a state of equilibrium. If we have buyers being equal in strength to bears, price will tend to consolidate. Now, it's very important that I show you this in the chart. Clearly, you can see this area here, this zone here. Do you see? Price is consolidating sideways. So at this point, long-term traders, remember we've said long-term traders are two players. It's either they are bulls or sellers. So at any particular time when the bulls and the bears are equal in strength, the market will tend to consolidate that way. Then we've also said that when the bears are weak while the bulls are strong, remember these bulls are strong in meaning they are pushing the market upward. The bulls are strong while the bears are weak. So the market should be going upward. And we've said there is a special characteristic of the way the market behaves when the bulls are in control. It will be pushing price higher high, higher low, higher high, higher low, higher high. No, that cannot be it. Let me redo that. Let me redo this. So we've said it will be pushing higher high, higher low, higher high, then higher low, then it pushes strongly all the way to this point here, up to there, then higher low. So this is higher high, higher low, higher high, higher low, higher high, higher low. So this is the way the market behaves when it's going upward. Then we've also said when we have bears in control and buyers are weak, the bears will tend to be to push price down. And we've also said when the market is going down, it's making lower low, lower high, lower low, lower high, lower low, lower high, lower low. It's very important you understand how to trade these markets. You spend some time and read how to trade these markets. There is a way you can capitalize on how they're moving. So for example, if the bulls are pushing price upwards, you want to join the trend. You want to join them in pushing the price upward. If the sellers are pushing price down, you want to join them in pushing the price downward. You do not go against them. You do not buy a market that is going down. You do not sell a market that is going up. Now, the concept of support and resistance. Support and resistance are levels in a chart. Let's start with support. Support is a level on a chart where buyers find value. So if buyers find value, it simply means that they'll be interested in placing order at that particular area, or price will most of the time come to that zone and be pushed back up. So it will come up there and be pushed back up. It comes again and it's be pushed back up. So when you find a level that is behaving that way, that is what we call a support area. While if you find a level where sellers are finding value, price is coming there and being pushed back down, coming there and being pushed back down, coming there and being pushed back down, that area is what we call a resistance zone. So for example, on this chart, we've identified this area. See this area. And you see when price comes to this top, it's being pushed back down that way. So most of the time when price is consolidating, it is playing within a resistance and a support. And we've said when you see the market behave that way, it simply means that the buyers are equals to sellers. So the market is moving sideways. Now, there are ways of capitalizing on this opportunity. You want to sell when price comes back to this top point, when price comes back to this point. So at this point, there's equal balance between buyers and sellers. Then we need to talk about demand and supply. Now, demand zones on a chart are areas where buyers will come back to the market and push price up. Like I've told you, for example, if the market is playing sideways. So we have two types. We have static demand and supply zone, and we have shifting demand and supply zone. So if the market is moving sideways, like that, there are areas where buyers are interested in coming back to the market, and buyers are interested in this zone down here. Buyers are interested in this level, this support zone. So these areas where buyers are coming back into the market are areas which we call demand zones. While an area where sellers are coming back to the market, these are areas where we call supply zone. So this is a static demand and supply zone where the market is moving sideways and buyers are coming into the market at the support while sellers are coming into the market at the resistance. While we have shifting demand and supply zone. So this is applicable on a trending market. Like we've said, if the market is going upward, it should be behaving like higher highs, higher low, like that. It's a zigzag move going upward. Now, there are levels where buyers are coming back into the market. This zone, you can draw a trend line touching on that. And these areas are where we call shifting demand zone because these are areas where buyers are coming back to the market. So if you want to trade this kind of uptrend market, you want to join them with the shifting demand zone. You want to buy at this point. You want to buy at that point. You want to buy at that point. To buy. Well, if the market is going downward, we've said it will be making lower lows and lower high. So when the market is going down, it should be making lower lows, lower high, lower lows, lower high, lower lows, lower high, lower lows, lower high. Now this point here is a shifting supply zone. So you want to sell at that point because these are areas where sellers are coming into the market and pushing the price down. So this is a shifting demand zone. So let's go to the chart. We see if we can identify some of these things. So we could start with a shifting demand or supply zone. So let's zoom out. And usually when you want to do this type of analysis, you must be able to see the bigger picture. So for example, at this point here, you can see this is a market going down. And you see, at this point, sellers come back to the market and they push the price back down. So they push it all the way down to that point, then we come back up. Then we get sellers coming into the market and pushing the price back down, you see. Then we get them coming in back to the market and pushing the price back down, you see. So these areas are what we call shifting supply zone. These are areas which, if you're trading a downtrend market, you should be interested in entering at this point here. You do not sell at this point. You do not sell here. 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 You only want to sell at this point, and this point. And that's why we say you should be looking to sell high, because this trend line here is behaving as a resistance and it is a supply zone. This is an area where sellers are coming into the market, they're finding value and pushing the market back down. While for demand zone, if I draw a trend line from this point going up, you should be able to see that whenever price came to this trend line, it was being pushed back up, you see. And you can also see that the market is making higher high, higher low, higher high, higher low, higher high, higher low, higher high. So in this setup, price is pushing upward. In this setup, price is pushing down. So this is a bulls in control, sellers in control. While at this point here, we have equal demand and equal supply, where buyers and bears are equal in power. So at this point, you want to sell at the resistance, while you want to buy at the support, because this is the demand zone, this is the supply zone. So that should be it for now. Let me know what you think of this content. As always, subscribe. Thank you for now.